Welcome to the 6th episode of the Farms of BC podcast. My name is Jay, and today we're going to be sitting down with Nav to discuss farm financing. Whether you should be going with one of the big banks, a credit union, or a private lender, stay tuned to find out. All right, bro. So, farm financing. Now, this is a topic that every lender, every client asks us every other day. Yeah. It's a high value topic, but I do want to put out a disclaimer before we start. Obviously, we're not lenders, we're not mortgage specialists. We do recommend working with the mortgage specialist that you're working with, most commonly or know best. We can always make recommendations, and we'll leave it at that. This is simply just from our experience and what we're seeing from our side in the
just world. Kind of our expertise of what we've seen and our experiences.
Perfect. And I want to just start it off with a big discrepancy between residential and commercial financing. What's really the differences between the two, and what should people know about that?
Well, residential financing, they're a little bit more lenient on when it comes to down payments, the percentage of down payment. Residential is typically about 20 to 25%. And then commercial is typically about 25 to 35% down. Now, those down payments are going to vary just from the type of product. They'll really look at the type of product and does it have farming income, does it not have farming income. So I'll give you an example. A 5-acre with a nice house, you would just think it would fall under residential, but because of the farming component, most banks or institutions will classify that as commercial. If you have farm status, even on a smaller 5-acre, they'll classify that as commercial because you're applying for farm status. I know some credit unions, even if there's farming income off of a smaller farm, they'll still declare it residential if they don't account for the income coming off of that farm. If they say, hey, okay, let's pretend that this revenue is not here, and you're just doing the land and house, then they'll classify it as residential. So every bank and every institution is going to value each farm differently. But the big differences are typically down payments and interest rates. Bigger down payments for commercial, smaller ones for residential. And on the interest rate side, it's typically about 1% to 1.5% difference, higher on the commercial side. Right. Those are the two biggest differences. When you dive right in and you really look at what falls under commercial, what falls under residential, I'll give you like an overview. Most agricultural properties that are under 10 acres, and this is a blanket statement that most of the institutions under 10 acres that have no farming, that have no agriculture, and there's an existing home on the property, and you're going to be using that as your principal residence, will fall under residential category. Okay. Right? Now, say if has a house, but you're going to use it as an investment, they may classify that as commercial. If you have some sort of agricultural income off of it and farm status, they'll classify that as commercial. If you're going to use the rental income or the farming income, they'll push that to the commercial side.
What about like land only or something like that?
That's a good question. Land only, it's its own category. Even if it's bare 5 acres, 10 acres, we've seen most institutions requesting 50% down. Yeah. The only time I've seen the exception is if there's no crops and it's bare land. I've seen most of the institutions giving 25% down if they have farming experience and they've got some sort of farming business plan, some sort of historical or future plan of agriculture.
Is that more rare though?
This has just changed recently, and you know what? These rules and regulations continue to change depending on the bank's appetite. When they're very aggressive to lend, they'll ease up on some of these rules. When they want to tighten up, they'll be more strict on them. So, couple years ago, it didn't matter. If you had bare land and you were going to do any agriculture, you'd got 25% down, as long as you can debt service. Now we've seen a lot of the banks tighten up just with the financial markets and the way they are. They're requesting, they just want to have that security, so they're asking 50% down and only giving 25% down to clients that have farming history or have a business plan, or that have a business plan and a manager in place that has farming history.
Okay. Yeah, we've seen that one.
Yeah, we've been through that one before, yeah.
Now, on the side of, a land-only farm, for example, there's no residential property on it, so it would be by default a commercial application?
Yeah, so if there's no house on it?
Yeah.
Yeah, so if there's no house on it, it would classify as commercial.
Even if it's a small acreage?
Even
like
if
1
it's
acre, 2 acres, something like that?
1 to 2 acres, depends. You can kind of, it's still on the higher down payment because you can still classify it as like a building lot. Okay. And like you and I see it all the time. Anybody that's really buying like 3 acres or below, they're not really buying it for the agricultural purpose. They're buying it to kind of have the estate. They want to build a nice house, build a nice barn, and they want to have the open space. Yeah. It's a lifestyle.
We've actually had it between conversations with our mortgage lenders and whatnot, and basically they've been stating that a lot of the 5 acres really can't be classified as commercial because they're very small hobby farms. Yeah. And sometimes they don't want to take that into the commercial realm, so they kind of say, maybe a smaller bank or smaller lender might be a better option for them.
Yeah, so I think it falls on the type of farming that's on there. Yeah. And like most institutions, as long as they're not allocating the revenue off that farm, even if it's 5 acres, if they're not accounting for that revenue, then they may get the exception to classify it into the residential. But say if the farm is generating a $200,000 and you say that's a 5 acre residential farm and you want to use that $200,000 into your debt servicing, the bank is going to push that into commercial. Right? And then again, it goes back to the client. It's a case to case.
It varies so much. I mean, if you have a smaller home, maybe you don't want to declare it and don't want that farm status, you're fine without it, right? So it makes sense for them to not do it. But if you have a larger home and you want that farm status, you got to show something. Yeah. And by default, that might be a commercial property then. Yeah. Okay, awesome. And I mean, now getting into a little bit more of the nitty gritty of the types of banks, we actually are on the same floor as Farm Credit Canada here in Surrey. Farm Credit Canada is the only specialized bank in Canada for agriculture purposes, right? Yeah,
so their mandate, and they are a credit union at the end of the day, but they're backed by the government. So it's a Farm Credit Canada. It's a Canadian institutional bank that provides agricultural lending only. Okay. So they will not go and give lending to a development property. It's strictly catered to farmers across Canada. Yeah, they've got special programs that cater to young farmers that are becoming farmers. They'll have better creative payment plans. They may adjust the way your payments are paid based on revenue coming in of the farm. So I'll give you an example. Blueberries, we harvest in June, July, August. But we don't get majority of our funds till the end of the year or the following year. So the way Farm Credit Canada does it with us is we pay 50% of the payment. So if our monthly payment is $10,000 a month, we pay $5,000 a month, and then we pay a lump sum at the end of $60,000. It's still going to be equivalent to $120,000, but they'll do 50% monthly, lump sum, combined 50% at the end. Now, keep this in mind, FCC is not the only one that provides that service, but a lot of the institutions now, the big banks, which we'll go over, they all started catering to the actual farmer. Yeah. So now, FCC was really standing out with these types of programs. They also did interest-only payments for the first 2-3 years, just so your farm can get up and running. But we've seen some of the other big banks jump on that program as well and provide interest only to really work with the client to get them up and running, right? Mm-hmm. So nowadays it's Farm Credit Canada, yes, that's their mandate, that's the bank for farming, but there is so many other options out there. And we always look at the client, we look at where they bank, existing bank relationship. We look at what type of product they're buying, and then we look at what type of income they have and how much supplemental income they need off the farm in order to get the approvals.
Now, Farm Credit Canada, just to sum it up, it just seems like there's flexibility there. That's all it really comes down to. They have flexibility for actual farmers. When you're actually getting into an agricultural purpose, they'll have
that's how they started. But we're now in 2023. Most of the big banks, they've now adopted that, is what I'm trying to get. Yeah.
Gotcha. Yeah, it used to be that agriculture wasn't very easy to get into with the regular banks. It wasn't something that was, readily offered, and a lot of things didn't count when it came into income. When it was
income, just the bank's risk tolerance. Well, they didn't have an appetite for farm financing, right?
Now they accept a lot more variability in the financials, right? So, yeah, no, that's awesome. Farm Credit Canada is definitely an option, but from my understanding, there is a rate difference between Farm Credit Canada and the big banks, typically.
Yeah, so some of the other big banks are like TD, Bank of Montreal, Royal Bank, Scotiabank, National Bank. I know a lot of people don't know that, but they also have all of these big banks. They all have a farming division. With the bigger 5 banks, we find it that they have a slighter lower interest rate than Farm Credit Canada. But we do see that Farm Credit Canada is a little bit more flexible on terms, payment plans, and things like that. So again, it's every product, every financial product is not made for everyone. You really have to look at the client that's looking for the funds, and then it's best to talk to certain banks. And we always advise, don't talk to just one bank. Talk to 2-3 banks. Talk to a mortgage broker, see what they can get for you. There's something that you might not be thinking about, that there's a lot of good farm mortgage brokers here in the Fraser Valley, Greater Vancouver. There's a lot of them.
Yeah, no, we'll definitely get into that because it's a topic right there. Now, inside the big banks, the 6 main ones are RBC, TD, BMO, CIBC, Scotiabank, and we got National Bank, and you could say HSBC is a big one as well, but less seen around, right? So out of these banks, that's the main thing that I've found is that there's 2 real differences. One is the interest rates. Typically, it's a little bit more accommodating there, but it's very hard to get approved for that. It's harder to get approved for that because they're mostly like AAA or there's other ones that aren't AAA in those, but even so. But if you do get approved, you get treated quite well because you get bonuses on other products you may have. There's always some sort of loyalty within the banks.
Loyalty program.
And if you really wanted to keep your farm financials within a big bank and also have your own personal banking on the same side, you get a lot of perks.
That's right.
To keep everything within one house, right? So that's one advantage. There is advantages to switching from one bank to a different bank. When you're bringing all your assets in for the first time, obviously they're going to treat you like royalty, right? So you're kind of coming in for the first time, and sometimes that's the only way you can get what you need. And
well, you have a stronger negotiating power. We are in an environment with high interest rates. That being said, a lot of farmers' renewals might be coming up here. I would highly recommend, give your existing bank the shot to give you good offers, but I wouldn't sit there and rely on that one bank. I would reach out to 2 or 3 other banks, talk to a mortgage broker, and say, hey, my renewal's coming up. I've got $20 million worth of assets, and I've got about a $2-3 million loan. And I've had this situation, I had this conversation a few times in the last month, and I've told some of the farmers, well, why are you not shopping this?
That's right.
Why are you just going back to your regular bank and settling for taking what they give you? You're high net worth, low debt level, cash flow is okay, but you need to go out and be a little bit aggressive, and that's where mortgage brokers come in handy. That's their job. Their job is to gather all your information, look at it, analyze it, put a good package together, and then shop these banks and get the best interest rate for your client.
Right.
Yeah.
Because, it's one thing that you know how to pitch what you have to the bank. However, it's a different thing when a specialist is pitching what you have to all the banks.
And also know how to rebuttal and negotiate.
Yes.
Like they will negotiate the rate, they will negotiate terms, they'll negotiate fees.
And we've had it sometimes where, we'll come in with an application to a specific bank, and you may do your best to get what you get, and they may turn you down. You bring the same thing to a mortgage specialist or a mortgage broker in some regard, right? And they pitch it to the same bank and they get approved.
Yeah.
It's just in the way they structure the deal.
Structure the deal, yeah.
And some guys just got it. They know how to do it. They know how to get it done.
They've got experience.
Experience. That's exactly it. Absolutely, I think having a friend in that world is really useful. Just as it is for a realtor, to be helping you out. You should always have a friend that's in the lending side as well. So that covers definitely the big bank side of things, but we also have another player. We have credit unions.
Yep. A lot of people don't know that credit unions. There's been a bigger appetite for farm lending from credit unions here in the last, I would say, 4 to 5 years. Right. And we've been seeing a lot of new players come into this playing field, and they've been quite aggressive, really good on interest rates, really good on terms, and fees. Yeah. So you should always take a look at some of them. I know there's Envision. Envision, then there's Khalsa Credit Union, Aldergrove Credit Union, Canadian Western Bank. I know there's a few. Van City, sorry, yeah.
There's definitely more out there. But.
Yeah, those are some ones that we've kind of dealt with here in the last couple of years that just started really getting really aggressive on agricultural financing.
And we found a little bit more flexibility there in comparison to the big banks.
Yes.
Just a little bit there. And sometimes if your banks, for example, and this is just, things you can vary. There's terms, there's, 25 years versus 30-year amortizations. Yeah. There's, obviously the rate is a big factor, right? So there's so many different variables that they can adjust. And it just seems like the credit unions are willing to, they got a little bit more risk appetite. They're able to adjust.
Well, that's just it. It's the risk appetite. It's and these credit unions, they're also opening a whole new portfolio in their book. Agriculture wasn't a product that they've been aggressive on. Right. In the last 4 or 5 years, they've been wanting to grow that book. So in order to lend out more money, they'd have to get aggressive. They've been very aggressive, like in the last 5 years. We've done a lot of deals that the big banks have lost and went to credit unions. But we've also had, we've seen it both ways. Like we've seen it where people have gone to credit unions and they thought they were getting the best deal, but just weren't happy there because they don't have the full service bank. Right. And then they wish they went to a bigger bank. So literally, you have to really look at the client and look at their needs, not needs immediately to get financing or just to refi. Like you got to sit down and figure out a 5-10 year plan. What do I need this money for? How long do I need it for? What is my payback plan? And according to that, you got to look at all of these different banks and say, what type of products do you have to fit my goal? And then once you find those banks, then you go and negotiate with them who give you the best terms and rates. You don't just go and throw your application to everybody and say, hey, who gives me the best rate? Rate is not always the end all be all.
That's right.
You got to look at the big picture and you got to look at the long-term picture.
For example, and this is just a classic example where, a lot of folks will go for the best rate possible, and it may be an obscure credit union or, some smaller lender that they don't, isn't very prominent. Yeah. But then they want to get a line of credit or a home line of credit, and you can't get it with that small-time lender, for example. Whereas if they had it with their bank, if they had their mortgage there, if they had their financing there, they can go and get a home line against that. Yeah,
what we have seen is the credit unions will do lines of credit. It's not that they won't.
Oh, it's not the credit union. I'm saying it's smaller lenders. There's a lot of smaller lenders that won't.
What we've seen is they get a lot more flexible when you bring a lot more products to them. Mm-hmm. So if you had, say, this farm purchase you were buying, but you were a trucking company that owned a truck yard and a house, they would say, hey, you guys got X amount of loans there. Why don't you bring all that? We'll package your farm in. We'll get you a better rate. Now, keep that in mind. The big banks do that too. Mm-hmm. They want to try getting all of the client's business, not just that one individual purchase, right?
That's right.
And sometimes it works out for the client's favor, depending on if they can structure the whole situation better.
And I mean, it is convenient to have everything under one umbrella, especially for estate
Sometimes.
planning. Estate planning, when things go awry, it's you're just going to one bank and you're sorting everything out. They package everything together, and you're off. It's done. Whereas if there's multiple banks, you got a lot of work to do.
I think what I've seen is people with a very big portfolio and a diverse portfolio, residential, commercial, industrial, farming, I've noticed they don't stick to one bank.
That's right.
Ever. Yeah. They spread the wealth. They spread the relationships.
And it helps because you got leverage in different places.
Correct.
Right? And that comes back to being able to switch when needed to get the best deal.
That's right.
And lastly, we got independent mortgage brokers.
Yes.
Maybe we can speak to that in terms of what's the best way to go about that, because there's so many, then what can they offer? And
I would always recommend that if you are going to use a broker and not go to the credit union or bank by yourself, try to look for someone that has done a few farm deals. They will have the experience of knowing how to package these deals together. They will have the relationships with some of these bigger banks to negotiate better with. That being said, if a mortgage broker can do all. They can do industrial, commercial, residential, farming, everything. We've just seen better success when an individual is going to someone that's a little bit more experienced and know how to structure these deals. And you know what? There's nothing wrong with mortgage brokers. We do get a little bit of kickback from buyers and other people saying, "Oh, I don't want to go to a mortgage broker. I'm going to have to pay a fee. My fees are less." But if there are a lot of times, not all the time, but there's a lot of times where I've seen the mortgage broker get the client a much better interest rate. Yes, they charged a fee, but the fee amount is very nominal compared to the amount of savings they're going to have for that 5-year fixed year term.
that's right.
So if you've got that long-term thinking, it's better to pay the fee, depending on which mortgage broker you're using and with their relationships that they have with the other institutions and banks.
That's right.
So I would never just say don't ever use a mortgage broker. Use a mortgage broker if depending on what type of product you need from the bank, and they do well. And you know what? The big banks plus the credit unions, they love it. They love when mortgage brokers bring them deals, right? They want to be able to cater to them. They have their own personal relationships. The big banks and the credit unions' main goal is to fund, right? They want to get that money out and get it rotating, right? And these mortgage brokers, they've got access to all these clients, and they've built these relationships with some of these commercial agricultural bankers. And then you don't have to go and do all that legwork. You don't know how to negotiate some of these terms. They are different from development, commercial, residential, right? And they'll have the experience of what to negotiate, what interest rates, how far they can push, and they take care of that. And I most times where I've seen it, it's worth paying that fee.
And I mean, they also do equipment financing. There's so much more.
Oh, they've got an umbrella, yeah.
Yeah, and the one big difference I've seen that kind of in difference of big banks versus, say, a mortgage lender or whatnot, there are some banks out there, the AAA banks, I believe it's RBC, BMO and such, that have rates that they're not giving out to the mortgage specialist community. So I believe that's my understanding. So there's some rates that they have that they hold for their clientele within the bank. Oh, really? So that's the one thing I've seen.
Yeah.
But I would definitely dig a little deeper with your own bank for that purpose, because it's a little fuzzy on that side. But at the end of the day, there's so many options out there. It's really important to kind of do your due diligence on it and really run the options between at least 2 or 3 banks and really get an idea.
We get it all the time. Even if you're buying a farm or refinancing, and you might have a private deal or a direct deal, or you're a realtor using us as a realtor or not. Reach out. We analyze your situation. We'll make the introductions. We do it all the time.
And we know which ones are doing well and which ones may not.
Well, I think based on what the client's looking for, or the person that needs the help, we'll look at their situation and say, hey, these are the guys We'll make the introductions. You go ahead and do what's best for you, right?
Absolutely. And lastly, private lending. When does that come into play?
Private lending has been a big player in the agriculture financing world here, especially in the last 3 to 4 years. Right. Private lending, a lot of the MICs don't do it. We have good relationships with all the MICs that do it.
What are MICs?
MIC is like it's an institution where they'll lend money to farmers or just to people for a higher interest rate. Okay. So they're like a fund, and so there are a few good ones out here locally that do it. What we've noticed is that most of these funds are mixed. Not all of them want to take the agricultural product because they don't understand it. When you're lending on a product, you have to understand it. So we do a lot of consulting for a lot of these MICs and these funds. We've noticed that they've been ramping up their portfolio here in the last 3 to 4 years. What we always advise people, and even the funds themselves, you don't want to take private money for long term. I would say no more than a year. If you don't have an exit strategy of getting out of that loan, you shouldn't be buying it, or you shouldn't be getting into it. If it's a year, you have a plan of paying it back quickly. It might be a month, it might be 6 months, might be a year. Then I've seen people take that risk and they've done very well. Right. And when do you use a MIC is kind of when you need money last minute, or you can't get financing, or you need it as a bridge loan, or you just need to fill a gap. Yeah. Right?
Before you get your real financing in play.
And a lot of these funds want you to go to these traditional banks and get traditional financing. Look, no bank or credit union or fund or MIC or none of these, they're not in the business to foreclose. That's not their goal. Their goal is to fund, move the money, rotate it again. So they know these things are short term, and they're okay with that. The funds are not in it that you borrow the money for 5 years. They don't want to do that. Right? That's why they only give you 1 year terms.
Yeah, and the rates are high, but
rates are much higher. Small. It's short-term sacrifice for a bigger picture for a longer-term gain. Why someone would use it, right? I've seen people use it on construction. Just say they need maybe a couple $100,000, like say $300,000 to $400,000 to finish their house, but they've got a payback plan. Once the house is done, they'll go back to their traditional bank. They'll refinance. They'll pay out they'll refinance. They'll pay out the mortgage, the private lender, and then they'll get traditional financing for the remainder of the loan, right?
And I mean, it's dangerous too, because I mean, if you're not doing it right, you could be getting yourself into a big hole.
Well, if you're abusing it.
Yeah.
It's not free money.
Yeah, exactly, right? And some people get too aggressive too quickly, and they don't have all their eggs sorted out, and it can bite you back, right? So that's kind of where, but it's a highly aggressive strategy that can have a lot of benefits.
Yeah, and we've seen a lot of people use it here in the last 3 years.
Oh yeah.
Especially when the market was in the incline, a lot of buyers had to get private funding, close on the property, and then spend the next 30 to 60 days to actually pay them out. And yes, they had to pay fees, but they really wanted the property. They had no choice because they're in so much competition out there.
We still have clients that are still in privates, and they're still working to get it out. They're still trying to get regular financing, and sometimes that's an issue, right? And that does result in them having to sell at some point if they can't get it. And it's just the reality of it. I don't want to get into too much of your personal banking right now, but maybe more historically, what have you had experience with in terms of banks?
We've used TD in the 80s and 90s. We've moved over, and that was when we first got into farming. And then when we were in expansion mode, just buying more property, more farms, and expanding the blueberry business, we went to Bank of Montreal. We felt they were more aggressive at that time. This is late 90s, early 2000s. They were more aggressive. They were more comfortable lending. They were wanting to grow their portfolio. And then after Bank of Montreal, when we went into the third phase of expansion, then we went to Farm Credit Canada. Farm Credit Canada gave us, because at that time we were higher debt load income, we had new plants. Farm Credit came in and they did an amazing job on the interest rate, the structure, the terms, the loan to value, everything. They did a really amazing job. We've used mortgage brokers before. We've used a lot of mortgage brokers for a lot of the stuff that we do. One thing is like, every time you're in a change of a plan or coming to a refinance, we look at our options. And I think, right now we're going through a phase of construction where we should be done a lot of our infrastructure here in the next 2 years. So right now we're not doing anything. We've locked everything in for the next 2 years, but we're going to be open to, once we have to refinance, we're going to shop it, right? And I think everyone needs to know is your existing bank is not your only option.
I think that's the most important note here, because there's people that do stay with their bank for an extraordinary amount of time.
And which is good.
Which is good, because there may be
they have that loyalty
bonuses,
yes,
right? Because that can be significant, especially when you have a family and you're just trying to be organized and you want everything in one house. I get it, right? Yeah. It is a convenience there.
What about your guys' self? Who do you guys use?
Yeah, I mean, more on the farming side, we've definitely been with CIBC for the longest time.
Yeah.
And aside from that, we did do some work with FCC when we were getting really aggressive, but that was more so along that time of 2008, around there, right?
Yeah.
So that had its own issues because of the economic environment at that time, right?
Yeah.
So after that, we were just kind of sticking with CIBC ever since, and on the farm side, and going forward, I think we're going with RBC and a couple others there. We're still looking into.
We're still looking, because you guys are gonna
there's gonna be new things coming up.
Your life, your farming operation is starting to change, right?
Yeah.
So there's a lot of moving parts.
Full reset, right? So we're kind of we're still open for business. We're still looking around, and we'll do our research.
Yeah.
Along with everyone else. I guess, who do you recommend when somebody comes up to you and they're like, what, I need a lender? What do you say?
Or I need financing?
Yeah.
Honestly, the very first thing I say is, who do you lend with? Who do you borrow with now, currently? So a lot of them don't even realize that, so if it's a new purchaser, a lot of them don't know that their existing bank has an ag division. First things first.
That's so correct.
Before you go and start, so if it's RBC, TD, or any of the big banks, I always say, give me what bank you're with. Okay, here's the contact for that specific bank. Then I go into, what's your down payment structure? Where's the money coming from? What's your income like? The farm that you're trying to purchase or refinance, what's the income like, or how much do you need it to debt service? Then according to that, I typically give them 2 to 3 other options. I don't like to give one, because for us in our space, we're not lenders. Our job is to give the client as many options and let them decide what's the best option for them and their family.
And there's so much depth that we can't even scratch, that we need these specialists to have that conversation with, right?
And moving into our podcast moving forward, one of our goals is to have multiple different banks and different institutions, from private lenders all the way to the big banks, to have come on our show and just talk about kind of what they want to, like what they offer, what their banks offer. Yeah,
it'd be great to kind of have that out there, right? Yeah. Obviously, things change rapidly, so it may change as we go, but we may actually increase the frequency of episodes, and that may become a little bit more relevant as well. Yeah. So there's lots of ways we could play it, but absolutely, I think having actual experts on here with that mortgage lending experience, really be able to speak to it would be ideal. And lastly, I'll give you some final comments, but I did think of something here as well. I mean, on the equity side of things, a lot of the times a farmer may have a lot of equity in what they own. It may be all
which
paid
most
off.
farmers do.
Yeah, and it may all be paid off, but they're still not going to lend against it unless you have income.
Correct.
You have to show some sort of income, and that's really where your planning comes in, because you have to plan ahead 2 years at least.
Yes.
Because at least show 2 years of income for the plan that you're trying to make in the future.
To execute.
If you're not doing that, then you're starting from that year, and you're going to have to plan 2 years in the future, because you're not going to be able to get that lending. I don't know if your thoughts on that.
No, I agree with you. The environment of lending back in early 2000s, they didn't really care about your income too much. It was, you've got this much equity. Yeah, no problem. You're approved. And I remember when I was younger with my dad, I'd go to the bank. The guy would just shove money down, like, hey, go buy another farm. What are you doing? Go buy another farm. Like it was so easy to get funding. It was all equity based.
Yeah.
Now it's all cash flow based.
Yeah.
So you know what? You could have a $10, $15 million asset, but if you're not showing income, you're not getting funding. Yeah. But then again, that's where private lenders come in. That's so right. Again, like you will get the lending, but you'll get it at a higher interest rate. And what we've noticed, funds and mix, they want to secure their position on the loan. So as long as the loan to value is really good, they'll lend. They look more at equity than they do at cash flow, because they're trying to protect their position of the loan.
That's right.
Yeah. Right. Yeah. So, but again, I would not take that unless if you have a payback plan.
Yeah, you got to assume that you're going to be getting into something
to pay that back.
That's going to be exactly into a traditional lending situation.
That's
right. Awesome. Any other final comments on that?
There's just so many good professionals out there in every bank or credit union or mortgage broker. Have multiple meetings. Don't just sit there and think that my friend used this person, or this bank my friend used this bank. Mm-hmm. Go out and actually talk to multiple people and really feel who is going to have your back long term. It's not just funding the deal or refinancing. This is your marriage or relationship for the next 5 to 10 years. This is who you're going to have your relationship with. So make sure you go out there and interview. You're actually interviewing not only the banks, but you're interviewing the individual of who I want to have this long-term relationship, and which bank, institution, or mortgage broker is going to have my back when I need them moving forward. Mm-hmm. Right? That is key. It's the relationship.
Well, that concludes podcast number 6, Farm Financing.